Hey everyone, how's it going? Welcome back to another TraderLion tutorial. Today we'll be going through one of my favorite trading setups, and that is the 21 EMA pullback. We'll be talking about what the setup is, when to best use it, and how to actually go ahead and execute it, and most importantly, how to manage risk at the exact same time, because we all know that, breakout strategies are only as good as, how well they protect you if that breakout fails. So let's go ahead and dive right in. If you do find this helpful, go ahead and leave a like down below, subscribe if you're new to the channel, and definitely comment below any other suggested tutorials that you'd like me to make. We'll go ahead and make those as soon as possible. With that said, let's go ahead and dive right in and talk about what this setup is. So the 21 EMA is a really powerful and simple moving average. During uptrends in promising growth stocks, if we just go back to app, it often is a point of potential support. And where I really like to use it is as a stock is moving up the right-hand side from a consolidation, I love to buy pullbacks to that moving average, especially if they coincide with a really tight range that forms. So if we look at this overall setup with app, it's important to start from the big picture. Longer term, this has been one of the strongest movers of the past 2 years. We're in a longer term uptrend. And now, since basically this point in May 9th of 2024, we were consolidating. We were basing as, longer term holders. We're absorbing shares from anybody selling at these points. Basically, short-term holders were getting out for their own reasons, but there was enough support, there was enough accumulation where they were bought up after this decline, and the stock had moved up the right-hand side close to the highs of this prior consolidation. We actually tried to break out here for just a few days, few weeks, but ended up pulling back to that 21 EMA. And this is where this setup really shines. Is many people will see a failed breakout right here, and it doesn't work. It ends up pulling back. It might stop them out. They forget the stock, even though nothing has changed about the longer term prospects of the particular stock. Instead, really what's happened is that the risk reward has improved, because instead of just buying a breakout, setting your stop maybe, below this swing low or at a moving average where it's a little bit of a wide stop, you instead have a higher low to trade against and a really tight range that, again, you can trade against and put your stop right at the bottom of this low. And so if you do buy that kind of re-breakout, the reconfirmation off the 21 EMA, you've got a really good risk reward situation because of this setup that's a little bit under the radar and very tight range that you can allow, that allows you to manage risk effectively. So let's break it down again. We've got a longer term uptrend, a medium term consolidation period or basing period. We've got a move up the right-hand side where either we're pulling back and forming a range against the 21 EMA, or in this case, we've actually had an attempted breakout through these highs and a pullback to that 21 EMA after a failed breakout. And this happens, even a lot more during modern times where a lot of people are watching these breakouts, trying to trade them. You can see there wasn't really volume on that breakout. There wasn't too much coming in. And we see a failed breakout, pullback, and reset against the 21 EMA. And that's exactly what happened here with app 11 right here. So again, we've got a nice spacing period. We'll actually zoom in. We've got a move up the right-hand side, demands coming back into the name. We have that failed breakout and pull back and tighten against the 21 EMA. This is really key because this tightening, again, lets us in and gives us some insight about the supply and demand dynamics that are going on. We didn't see the intense volume come in. We didn't see a lot of accumulation signs on the breakout, but here this tightening in price and volume, where instead of falling to the downside, we're respecting that 50-day moving average, this line here. We move back up, we tighten up, form a range, basically 2 inside days, gets really, really tight. And from here, this is where the setup is prime for us to execute as we start to move up and break out from the short-term range. We're not waiting for it to break out all-time highs. We're waiting for it to break out of the short-term range because that gives us the best risk reward. So looking at this name, again, in the very short term, we had these double inside days. We had RMV, relative measured volatility, go to 0. This basically measures how tight a stock is. If it's close to 0, it's very, very tight. If we go back in this area where it was tight for about 4 days, RMV went to 0 again. Here it was tight again. RMV went to 0. And again, right here as the overall situation, context, short-term, mid-term setup, everything's coming together. We have finally double inside days, RMV to zero. That lets us know that the short-term setup is prime for a large expansion, explosion in price and volume. And what do we get the next day? We have a slight gap up and then a break through the pivot, the buy point, which is the highs of these two bars, strong close, huge volume coming in. And then what's even better than a one-day move is we get successive days up on increasing volume. And here we've got the true breakout into new highs, but you're not waiting for this breakout out here. You're not trying to buy it up here, because what would happen if you're waiting until then? Basically, you have no place to manage risk against. You have no logical and tight stop loss. If you're using the low of the day, let's just see how far that away that is. That's about 7%. And compare that to using the low of the day as this is breaking out here. That's about 2%. If you're losing the low of the range, that's about, less than 5%. So that's keeping a lot tighter than if you're waiting for it to be up here. And if you buy from this pivot point, this hidden buy point, you've got a cushion all the way on day one. You could sell half if you want to into, strength if you're more of a day swing trader, or if you're a position trader, you just have a great cushion to work with. And then you get successive moves up. You're at a great cushion already from this buy point. You're up about 30%. And at this point, again, because of that profit cushion, you've got options. You can sell half into strength. You can wait for a break of the 10 EMA on half and try to ride the rest against the 21 EMA or even the 50 SMA. And if you bought at this area, the 21 EMA is already well above your cost basis. So that could be your logical trailing stop. And you'd be watching for one close or two closes below that key moving average as basically your sell signal. So that is the setup. Basically, we're looking for either a tight contraction up the right-hand side, back in here against the 21 EMA, where again, we form that range, we form that short-term pattern, or we're looking for a failed breakout, pull back to that 21 EMA and reset. And that's when you can set your alerts right at these highs. Ideally have it on your radar already that morning as one of your top focus names because of this great short-term setup within the longer-term context, where you've got double inside days, RMV to zero, everything's coming together. And then that morning, you're not waiting to see if volume is going to come in. Instead, you're using a relative volume measure like we have in Deep View, where we've got the run rate on a 20-day basis, where this morning was screaming huge volume, up over several 100% in terms of run rate compared to normal. So you know it's going to be huge volume, and you see the explosive price and volume move. And that's when you execute right through those highs and catch a ride on this momentum leader. So again, that's kind of the overall setup. It works great in growth stocks, very promising moves. And you might be thinking, does this only work up the right hand side? If I see a stock that respects a 21 EMA, that's a strong mover, can I use it then? And 100% you can. For instance, VNO is a name that I put on my newsletter very recently, had a nice tight range against a 21 EMA. Then you've got the outside day. Again, this is your buy point. We can actually go ahead and draw in that range right here. This is your buy point through these highs, and you can get a great swing trade out of this. I prefer when it occurs up the right-hand side of a base or, shortly after the true breakout. And that's because there's just a little bit more potential for a name that pulls back to the 21 EMA well after the base breakout. It's been trending for quite some time. I would view that more of a swing trade opportunity where I'm looking to sell more into strength here versus just viewing it as the start of a trend and trying to hold for a bigger move. So you can definitely play those. You just have to handle them a little bit differently. But of course, this is perfectly valid. Again, you can use your, set your stop right at the low of the day, the low of this range, move up your stop to this low of the day once we get this bar, and you're off to the races. You can use the 10 EMA as your sell signal, or look just to sell into strength. And again, this has been a really nice mover, up 10% in a REIT, which is simply, those have been working recently. So this isn't even technically a growth stock, but it's been in a very strong trend, that's been working. So this setup, which if we go back to app, has a lot of potential and can lead to really explosive moves just like this one. And if you go back and study the biggest winners over the past few years, you'll notice that almost all of them have this type of setup at some point during their moves. And I think one more way that this is great is, as I mentioned, if you feel like you missed the breakout or, whatever, it went without you, oftentimes it will reset pretty soon versus that 21 EMA. Maybe that occurs back in the base as this one did, or a little bit higher. You know, the first pullback to the 21 EMA, that is a prime spot to kind of jump on a leader that you quote unquote missed. And instead you've almost got a better risk reward setup, because instead of trying to buy a breakout that is a little bit too obvious, instead you're buying kind of a hidden setup with great risk reward and a clearly defined stop loss point, the bottom of that range or the bottom, low of the day on the day of the breakout. I typically use that. I'm a little bit more aggressive, but I know plenty of traders who just use the low of that range, that higher low, as their stop loss point. So there's a little bit of customizability with the setup, but let me know your thoughts down below in the comment section. Let me know if you've made any trades recently using this setup. I know it's pretty popular, and hopefully this was helpful to you guys. Leave a like down below if you enjoyed. Let me know any tutorials that you'd like me to make down below as well, and I'll see you guys in future videos. Take care.